Yes, thank you very much. A lot to talk about. Obviously, not enough time as usual. You know, as you may recall, last year I visited you, and I'm sure that you totally remember that I completely predicted COVID-19. I told you exactly what will happen with COVID-19. It was very predictable, as we all know. More seriously, I was actually looking at my presentation of last year just to see what we were thinking about back then. And we were talking about the negative yield curve in the US, the probability of a recession in the US, the trade war with China, deglobalization. Will the consumer be able to sustain the economy? Well, we were so young and innocent. It was so simple back then. So clearly, you cannot really talk in the same language when you discuss the economic implications of COVID-19. So I will try to put it in perspective. And of course, everything depends on the virus, everything depends on the vaccine, the speed of distribution. We all know that. So we'll talk about it a little bit in terms of the trajectory of the virus, the vaccine, the speed, what it means in the near term and the long term. Because at this point, what I'm interested in is basically answering three questions. One is how bad will the winter be? The second question is how strong will the second half be? And then, much more important from a long-term perspective, any scarring, basically long-term damage. Basically trying to answer to what extent COVID is an event or a condition. We'll discuss. But let's first start with the winter. Listen, nobody's under any illusion that this winter is going to be easy. It's going to be tough. It will get worse. We all know that. Nobody's expecting otherwise. Unfortunately, the case number will rise. Unfortunately, we will see the economy shrinking. We are basically in the midst of a double dip recession. So we know that that's a given. I think that the Fed is understanding that, and they will continue to support. And clearly, Biden is understanding that, and that's why he's talking about this injection of money. We'll talk about it as well. So that's basically the short term. It's going to be relatively bad. However, we can find some positives in the negative, namely, to what extent the current double dip recession is going to be different than the spring of last year, and it will be better. Yes, the second wave is worse in terms of number of cases. However, this is not going to be a complete closure compared to April and March of last year because we know better. Also, it's very interesting, 2/3 of the American economy now is in a full swing V-shaped recovery, 2/3. But 1/3 is stuck in this L-shaped recovery. That's this famous K, if you wish. So this 1/3 is already down. It cannot go down beyond that. So economically speaking, it's actually a positive because when you go from positive to zero, it's a negative. When you go from zero to zero, it's zero. So it's better, economically speaking. Then all of us, we all know that we are much more equipped using online capabilities. Businesses are much more equipped, much more able to do so. That's better relative to the spring of last year. Higher productivity. We are much more productive now, a year after, in this environment. I can find, finally, the mute button in Zoom. That makes me 20% more productive than last year. You look at construction, you look at manufacturing, and we speak to a lot of CEOs. They are seeing improved ability to work with social distancing in manufacturing, in construction, in sites, without compromising productivity. That was not the case in the spring. Another factor is confidence. Listen, last year in the spring, we were blind. We didn't know anything. Now we see the light. The only discussion is at this point how quick it will come. But the light is there and it's not a train. In this environment, you already can take some risks because you know where we are going. And we are starting to see it. We are starting to see some big pension plans are starting to invest in multi-residential apartment buildings, although they are soft, but they know what's coming. This was not the case in the spring of last year. And then you have fiscal policy, especially the $1.2 trillion that Biden is going to introduce, he will not get all of it, but it will get some of it. That will be enough to lift the US economy by 1.5% GDP growth, extra boost in the next 2 years. That's very significant. So that's the positives in the negative that is going to be very negative during this double dip recession. That's basically the starting point. Clearly, fiscal policy is playing a significant role here. The $600 that was improved just recently is a major factor preventing the first quarter from going deeply down. So this is a major lift, and more is coming. We are talking about $1.9 trillion. I'm guessing it will be getting maybe $1 trillion out of it, basically half. A lot of it will go to paying the extra $1,400 per person. We all know that. Also, a lot of it will go to local governments. They need the money. They desperately need the money, about $400 billion. And some of it will go to accelerate the vaccine distribution, roughly another $400 billion. So there will be a significant lift. He will not get everything, but he will get some that will be sufficient to lift the economy by 1%. Overall, if you look at what Joe Biden will be able to do, I call it a Biden light, if you wish. Namely, he will be able to get some of what he wants, given the situation in the Senate, which is basically not a blue wave, maybe a blue ripple. Clearly, COVID-19 plan is getting a lot of money now, and it will accelerate, we hope. The stimulus bill I discussed, it will get half of it. That will be plenty. I will be very happy if it gets $1 trillion. The tax plan, $3.1 trillion of higher taxes, not happening anytime soon. So you can see that the market is not spending too much time worrying about it now. Infrastructure is going to spend a lot of money on infrastructure, especially green. This is slowly becoming not a White House, it's becoming a greenhouse in Washington. Clearly, we are going to see a significant increase in spending. Again, it will not be 2021, not even 2022. It will be more 2023 story. After the crisis is over, we are going to see a significant amount of money going into transportation infrastructure because the transportation trust fund really needs some money, injection of money. They are going to do it. Immigration, very important, is going to open the gates. You will see more immigrants going to the US. Population growth will rise much faster than under Trump. Energy. Keystone is basically dead. This is something that is impacting Canada very significantly. At the same time, you will see a situation in which Biden will introduce a lot of regulations on the energy sector. They will slow down. It's coming. When it comes to financials, we just had the testimony by Yellen today, and we know two things about her. One, she supports big help. So the $1.9 trillion money is something that she will welcome. The other is regulations. She loves regulations. It will come to financials, not now. They know that this is not the time, but 2022, 2023, you will see increased regulations on banks. Obamacare, not happening anytime soon, any change until the Supreme Court is going to decide about it. So we are not losing sleep over it. Trade policy, it will be the continuation of Trump, but basically more muted. Namely, the trade war with China is not going to end anytime soon. We have a situation in which Biden sees China as a major issue. The only difference is that he will try to do it as a coalition with Europe, with Canada, as opposed to going alone. But the trade policy that Trump started, namely deglobalization, will continue after Biden, but it will be more muted, but it's not a reversal of that. This is the background given the elections, what I expect in the near term, medium term from Biden. Now let's discuss very quickly the virus. This is the US versus the rest. What this tells you, that for a given level of infection, the US economy was much more open than any other economy in the universe. Now, the positive spin, economically speaking, the US outperformed. The negative spin, the infection rate is much higher. So if you wish, the conflict that is defining this crisis, the conflict between lives and livelihood, is in full display here in the case of the US. And what Biden will try to do, and remember, the states implement the policy. But what Biden will try to do is to take this red dot back to where it belongs. That will have a negative economic impact that is trying to compensate for by injecting money into the system. And that's basically where we are. Clearly, we see the number of cases, second wave or third wave, depends how you want to call it. But look at the Midwest. That's where most of the cases were in terms of the speed of the infection. But you see that it went down dramatically. Why? Because we have seen more restrictions. We've seen the mobility index going down in the Midwest that led to a significant reduction in the infection rate. Very, very interesting, which means that it can work if you do the right thing. If you notice, look at this chart, yes, the mobility index is down, but it's not down to where it was in April or March of last year, again, reflecting the positives in the negative that I discussed earlier, suggesting that we don't have to really go back to where we were before the infection rate goes down. We just have to be smarter about it, and that's more or less where we are. That's the virus. Let's talk about the vaccine. And this is a very interesting chart. Let's focus on the US here. The US now is saying that we need 8 months to complete or to be close to complete the vaccination process. Now, this 8 months assumes 100% efficiency, and we are only at 60, which means that at 60%, it will be longer than 8 months. 8 months assume 100. So we are 60% at the rate that we need to complete vaccinations, 8 months, okay? Which means that the US is doing better than the UK, Spain, or Canada, but it's not enough. You need to get to this 100%. And I believe with the money coming from Biden, about $400 billion very soon, I hope that that will accelerate the process. And that's really what we need at this point. Everything is about this vaccine. And my working assumption is that within 8-9 months, the US economy will be vaccinated, basically, and will be able to take off. And this will happen before. Remember, the summer was very strong when we didn't have a vaccine. We had basically almost a V-shaped recovery without a vaccine. So we know that the summer will be strong. You get the vaccine, it's a win-win situation. And that's why I'm talking about a very, very strong second half. So the executive summary of my presentation is short-term bad, medium-term much better. So although we are in a double dip recession, I believe that the nature of the recession suggests that the recovery will be very, very strong. Let's discuss why. First of all, we all know that this is a service-oriented recession. This is very different than any other recession ever. All the other recessions started with goods, and the service was the second derivative. Now, goods are up. Retail sales are up, actually higher than they were before, because you press a button and you get your exercise bike. Services, very different. So all the damage is in services. Now, this means that the damage in the US economy this recession is very deep, but very narrow. What it means that the number of industries that are impacted is relatively small, but if you are impacted, you feel the pain. So it's deep, but narrow relative to any other recession. This means that when you turn a corner, when we get this vaccine, we will have a situation in which it will not take much to go back to where you were because the number of industries impacted is relatively small. Also, we are not losing really production capacity. Therefore, it's all there. And we are not losing ability or willingness to do so. People are dying to go to restaurants, but they are not willing to die doing so. So they are waiting. So this is the service sector. In addition, we have a situation in which a service business is much faster to recover than a manufacturing business. What I mean by that, it is much faster to reopen or open a new restaurant then establish a new manufacturing facility. The production capacity is there. You need to create the demand. Very different than any other recession where you actually lose production capacity. Then you have this. This is the most asymmetrical recession ever. You go to 2008, you go to 1991, even 2000, all jobs lost were in all wage categories. All of them fell. This is not the case now. High wage Americans did not feel the impact financially. The opposite is the case. Most of the decline, in fact, the vast majority of jobs lost during this recession were among low-wage workers. This is the most asymmetrical recession ever when it comes to the job market. Now, what does it mean? Well, it means that most of the decline in spending was actually happening among high-income individuals. This is very interesting because if you think about it for a second, it makes sense. Low-income households spend most of their money or government money, on essentials. High-income individuals, they are not the ones that spending because they cannot go on vacations, they cannot dine, they cannot go to the theater. So you have a situation in which they are reducing their spending, but their income is actually up. Because of government money, and because of the fact that high-wage individuals made more money this recession, income in the US is actually rising, not falling. The first time ever it happened in a recession. So you have income rising, high-wage jobs are there, and spending going down. Now, this means a few interesting things. For example, if you're a small business, and that's exactly what we're seeing in high-frequency data, if you're a small business in the US and you are tailoring to high-income neighborhoods, your business is going down faster than a small business that is tailoring to low-income neighborhoods. That's fascinating. We have never seen it in any other recession. Second, if your income is there, and in fact rising, and your consumption is going down dramatically, what does it mean? It means that your savings rate is going up. That's passive saving. You don't want to save, it's just happening. Your checking account, your savings account getting fatter and bigger on a daily basis. That's exactly what we are seeing. Americans, high and even middle upper income Americans are seeing a mountain of cash. In fact, if you put it together, the US is second only to Canada in terms of the share of savings in income. About 11% of annual income spending is now sitting in checking and savings account waiting. And this money will be utilized. We are now accumulating a huge amount of pent-up demand. And if I'm right, or even semi-right about the next 3 months, this number will rise because you cannot spend and your income is still there. Which means that when you get this injection, when you get the vaccine and you are ready to go, you have a lot of money to spend and the desire to spend. And you will be spending not on goods, you will be spending on services, exactly where you need the jobs. So it's a win-win situation. It will be a very efficient spending because it will go to where the economy needs it. And not only you have income, you have also wealth. This is the wealth position of American households. We have never seen anything like that in a recession. The housing market is on fire. The stock market is at record high, all because of low interest rates. So assets are rising faster than liabilities. Household net worth is rising at a rate we haven't seen before in a recession, giving you, again, the confidence to spend because you feel wealthier. You have the income, you have access cash, and you feel wealthier because your wealth is rising. Real estate and financial. That's a good starting point to increase spending. And then if it's not enough, you have low interest rates, making your debt payments much cheaper, and people are refinancing mortgages like there is no tomorrow. The refinancing rate is in the sky, and it's not cash out, as you can see from the chart to the right. People just getting better terms and therefore reduce their interest payments. Another savings vehicle to an already extremely elevated savings rate. No surprise, given this environment, that home builders' confidence index is higher now than it was before the 2008 crisis. Hard to believe, but low interest rates will do that trick. And even investment is not as bad as it used to be in any other recession, as you can see from the red line compared to any other recession. And this investment is helped largely by technology. The winner of this crisis, 50% of investment now, capital expenditures in the US is related to technology one way or another. And you can see that this is recovering and basically back to the 2019 level compared to other. So the technology story is very important when it comes to investment. Now, of course, all this is a function of where the economy is going and where the economy was and where it will be. Another factor that we have to consider is the US dollar. And as you all know, the US dollar has been going down and down and down. The question is how important a story it is. It's clearly important if you are investing and if you are into portfolio building exercise. But from a macro perspective, it's really much ado about nothing. This is the dollar depreciation, the yellow line today, compared to previous ones. So if you compare it to 85 or 2002, it's like peanuts, it's nothing. You can compare it to 2016, but nothing really happened in 2016 from a macro perspective. So don't expect the depreciation of the US dollar, which is a general depreciation reflecting the situation, to impact the US economy one way or another. The US economy is not so sensitive to the dollar, and the decline in the dollar is not as rapid. So that's very, very important. Therefore, you put all this together, and we see a very bad first quarter, and then a transition period in the spring, and a very strong summer and fall, suggesting that the economy will be able to close what we call the output gap by 2021 or 2022. This is very, very healthy, which means that at one point, the Fed will have to do some thinking. Because listen, the Fed is doing a lot of work here helping the government. The government has been spending money like there is no tomorrow. And people say, one, who is going to pay for it? Two is, what about inflation? Because the Bank of Canada is printing money. Sorry, the Fed is printing money. And when you print money, Economics 101 is telling you that you are going to have inflation. So let's discuss it. First of all, who is going to pay for it? Well, in the short term, of course, nobody's going to pay for it, because the government is going to recycle all debt with extremely low interest rates, and therefore interest payments on debt are actually going down, not up. However, this of course is unsustainable. Interest rates eventually will rise. And that's why I will not be surprised, if not now, but 2022, 2023, the debate will be dramatically changed towards how do you pay for it, and taxes will be part of it. So that will be the debate. Nobody's talking about it now because you are in a middle of a crisis. So the spending takes priority over taxes. 2023, when you are removed from this crisis, that will be the discussion. And we know what Biden is talking about, and we'll see what Congress will allow him to do, what the Senate will allow him to do. But that's a totally different story. But clearly, some increase in taxations will be required, not only to finance new spending, on infrastructure, but also to make sure that the budget deficit does not go to the sky. That's more or less where we are. Not anytime soon. This discussion is premature at this point. What about the Fed? You can make the point that the Fed is no longer a central bank. You can make the point that the Fed is a government agency, basically buying the bonds that the government is issuing, and by doing so, reducing the rate of interest. Maybe. So they will have to labor very hard after the crisis to reestablish their credibility. This is not a criticism because what they're doing is the right thing, but it's a derivative of the situation. What about inflation? That's the key question. You print like there is no tomorrow. Economics 101 will tell you this is not just inflationary, this is hyperinflationary. So first we have to remember that although we are this almost V-shaped recovery, the US economy is still about 3-4% below where it was before the crisis, and we know that we are going down now, so it will be even more than that. So we are in a disinflationary environment. In order to fight a disinflationary environment, you have to use inflationary tools. So inflation is fighting disinflation, therefore you have stable inflation. However, clearly, if I'm right or even semi-right about the rate of improvement in the second half, you will need the Fed to start reducing its involvement in the market. So what we are starting to see is the following. That's what Powell is telling us now. He's telling us maybe we should follow the example of Canada. And what Canada is doing is the following. Canada is saying, listen, we are going to spend less. We are going to reduce how much we spend a week, and the Fed is willing to do so, but we are going to target, we are going to aim better. We are going to tackle and buy those bonds that are relevant to the consumer. Let's buy those 30-year bonds to reduce or limit any increase in the mortgage rate. Same goes for the 10-year rate. That will help businesses. So you fire, you use less ammunition, but you target, you aim better. By doing so, you continue the stimulus with less money. That's something that they are going to do, and that's something that they are willing to do. Another thing that they are telling us what they are willing to do, and that's very important, is that they are willing to tolerate higher inflation without raising interest rates. This is very important from your perspective if you care about interest rates, because they are telling us at this point, we are targeting not inflation, we are targeting average inflation. What it means, you can have inflation at 1% for 2 years, and then you can have inflation at 3% for 2 years. The average is 2, that's their target. So it's a long-term average as opposed to spot. This means that you might see inflation, and Powell just last week told us that. You might see inflation rising during the recovery at about 2%, because remember, there will be so much demand, especially for services, their prices will rise. You go, you get your haircut, it will cost you more because everybody will be doing it. So there will be some inflationary forces there. And what the Fed needs to do is to reduce quantitative easing without spooking the market. And there is a risk that the market will be spooked. And there is a risk that the market will say, wow, they're not printing anymore, I'm out of it. So that's what we are going to face at one point in 2021, and we have to be ready for that. And if you do it on a gradual basis, and you tell them, listen, don't worry, I'm not raising interest rates anytime soon, even if inflation is rising, that will ease the pain. And that's more or less where we are. But we have to realize that this can happen. And that's something that they will have to deal with. So from a monetary policy perspective, the second half will be very tricky. The economy will be rising. You don't want to spook it. You don't want to slow it down too rapidly. You don't want to raise interest rates too quickly. You have to do it right. And in the process, you have to remove quantitative easing. That's a challenge. That's more or less where we are. One option of doing it is using what we call curve control. That's what the Bank of Japan is doing. They basically say, listen, We know that you want to take the 10-year rate, the 30-year rate higher because the economy is doing better. We are going to cap it. And we are going to say the 10-year rate should stabilize at X. And then they buy securities, they sell securities, they sell the bond market to keep it at this level. This way, the market has confidence knowing where the market is going, where the rate is going. We call it a yield curve control. That's exactly what the Bank of Japan is doing. And therefore, given this environment, I think that we might see a situation in which the Fed will start removing liquidity from the market by late 2021, and they will start raising interest rates at one point. The market today is discounting the first increase to be in 2024, and that's where I believe the market is wrong. If I'm even semi-right, and the recovery in the market, the recovery in the economy will be rapid at 5-6% in the second half of the year into 2022, we might see a situation in which the Fed will start moving earlier, basically in 2023. So I think that the market is wrong by basically 1 year, and I think that we will see slowly some adjustment to these expectations as we start seeing the light coming, maybe around the springtime. That's the global macroeconomic story as far as the US economy is concerned, as far as the virus trajectory is concerned. Now let's talk about the long-term implication. The last question, scarring. Is it an event or is it a condition? And that's something that we have to understand, because if you look at the experience of 2008, let's look at this. This is very interesting. Every recession, after it goes down and it stays down. So you see, that's 2008. There is something called the level factor that goes down. Now, scarring means that the potential growth of the economy in the new situation after the recession is lower than what it was before. Namely, if you look very closely at this chart, it means that the gap between the red line and the dotted line is widening slowly. If you look carefully, you can see that it's widening. This means that the speed limit of the economy, the potential growth of the economy, was reduced on a permanent basis because of the scarring, the long-term impact of the 2008 recession that was able to impact so many segments of the economy, especially productivity. So the question is, are we going to do the same, to see the same? Namely, is it an event? And an event means that it will stabilize at the same rate, or a condition that it will go down and the spread will widen. My sense, quite frankly, is that it is more an event than a condition. Going back to my discussion about the nature of the recovery, deep but narrow, service versus good, the speed of the recovery, productivity improvement, and many other factors that I discussed earlier. To me, when we reach the second half of 2022, we will be able to stabilize at more or less the same rate of growth that we have seen before the crisis. There will be some changes. Maybe people will be wearing masks during the winter, even after it's over. Maybe people will be washing their hands more often. We will be more aware of things, but it will not be a major dramatic change. In order to get a sense of this, you know what I do sometimes? I look at pictures from 1919, 1920, a year after the Spanish flu of 1918. And you see people partying, people together, not wearing masks, like nothing happened. I hope we will be in this kind of position 2 years from now. In this environment, there is no reason to believe that there will be a significant change in the production capacity of the economy and therefore the speed limit of the economy. Because remember, services versus goods, much easier to reopen services. Unfortunately, many small businesses will not survive this crisis, but many others will open. And it's much easier to open a service sector industry, service sector business. That's basically the story. So my short answer is that I don't see major scarring. Let's talk about the long-term implications of that. You know, when you're in a situation, you tend to exaggerate the real long-term impact of this situation. And we are in a situation. So people say, oh, the office model is dead. E-commerce is the way to go. Yes, remember, all those trends were there before. Every crisis is a trend accelerator. And this crisis is not very different. So all those trends were there before. So let's discuss. I think we will be back in the office. I think that the office will be still the main center of activity when it comes to work life. Yes, I admit that if it's like negative, if it's like minus 20 and snowing out, that day I will be working from home. It will be a more flexible environment. Maybe the notion of rush hour is a primitive notion. Who says that everybody has to be in the office at 9 and leave at 5? You can have your first meeting by Zoom and then go to the office. But the office will remain the center. Yes, demand for office space will go down, vacancy rates will rise, but it's not a complete change of the model, in my opinion. E-commerce, yes, of course it accelerated. We gained basically 10 years in terms of market share of e-commerce in 6 months. But then we lost 5 years in 2 minutes. What I'm telling you here is that e-commerce will continue to grow in importance, but don't exaggerate the speed of this transition based on what we have seen over the past 6 months. I think that offline shopping will be exotic. People are dying to do so, but it will be in high quality experience. So when it comes to retail, quality will be the dividing line. A permanent change I see in banking, in health, education, especially in education, where I see e-learning becoming a big thing, and permanent. I think that travel will come earlier than expected. It will start with domestic travel, and then it will be international, but it will be faster than expected. Restaurants, as I said, people will be lining up. And then, of course, we have deglobalization that was accelerated during Trump and was accelerated during this crisis, but it was there before. And it will continue after Biden, maybe at reduced rate. So what I'm telling you here is that, yes, the global economy is being transformed, but when the fog clears, everything will look very, very familiar. So to sum up, short term, bad. Medium term, much better. I think that the recovery will be very, very strong, reflecting the nature of the crisis. The vaccine is the issue. The speed of vaccination is key. But this crisis has an end game. And this end game is a vaccine. Between now and then, we are simply buying time. I will stop here and let's see if we have time for some questions or discussions. Thanks.